Good morning, everybody. Thanks very much to Rob for inviting me. I'm very glad to be back at an INET conference, first time in a few years. Topic of this panel is speculation and innovation. I won't repeat the introductions to everybody. First speaker is Bill Janeway from Cambridge, and just a quick word about Bill's book, which you should all buy and read. I've written 2 books about how terrible speculative bubbles are, so I feel a bit like Prince Charles moderating over a convention of modern architects here, because Bill and the others have got some more positive things to say. And Bill's book, in which he combines, I don't want to be modest about your age, Bill, but a certain number of years of experience with a scholarly resume which goes back to studying with some of Keynes' disciples, well worth a read. So Bill's up first.
Thank you, John. And the slides are coming up, I know, immediately. There they are. We've had a lot of discussion, and we're going to have more discussion of the role of the state. But there's another institution that has played that mobilizes capital at scale for projects whose return is uncertain. Is uncertain in Keynes' sense. It cannot be known. It's not, as Knight would have it, because we're not good enough at calculating. Now, speculation comes in multiple forms, and the first law of speculation, the first law of bubbles, is that they are banal, that anything, any asset traded in any market with minimal liquidity can be an object of speculation. And of course, Kindleberger, following Minsky, doesn't mention tulip bulbs, but that's where in the culture of capitalism, it all began and it has continued. Now, I think it is useful to distinguish bubbles along 2 dimensions. One, the vertical axis, is whether the asset actually offers the possibility of increasing and improving and enhancing life chances, economic possibilities. Productivity enhancing is the term I've used. The horizontal axis is where is the speculation taking place? And what I would argue is that when the object of speculation, from the canals through the railroads to electricity to radio and on to computing and the internet, when the object of speculation is technology that can transform economic possibilities, and when the speculation is limited to the liquid capital markets, when the bubble inevitably bursts, the consequences for the economy are relatively limited. Whereas when the speculation is about beach houses in the Nevada desert, and it infects the core banking system that provides working capital to the ordinary economy of production and employment and consumption, the consequences when it bursts are devastating, and it leaves nothing of value behind. So I want to be clear that when I talk about productive bubbles, it is a very special and limited case. But now this is what a bubble looks like. These are 3 stock charts, 2 of them from the dot-com telecom bubble of the late 90s that I'm delighted to say I was closely associated with, BEA Systems and Veritas. And the other is from 2 generations before, Radio Corporation of America, from 1926 to 32. Now, over the course of no more than 18 to 24 months, these share prices increased by factors of 10 to 20 times. That is a bubble. And by the way, it is recognizable whenever you see a stock chart like this. And the echo here, it's nice the way RCA fits so neatly between BEA and Veritas. But what happens in the stock market doesn't stay in the stock market, and that's the subject of this panel. Keynes, writing in the General Theory, constructed a conceptual bridge from the financial markets to the real economy. Note the way he anticipated the LBO movement in writing that it's no sense in building a new enterprise at a cost greater than that at which a similar existing enterprise can be purchased, while, of course, he anticipated the importance of the market for initial public offerings when he wrote that there is an inducement to spend on a new project what may seem an extravagant sum if it can be floated off on the stock exchange at an immediate profit. Jim Tobin set about operationalizing Keynes's insight in Tobin's Q, and he particularly called explicit attention in the seminal article with Brainerd, which defined Tobin's Q, to the impact of technological change on the relationship between the market value of assets and their replacement cost. But Tobin's Q has been predominantly deployed to evaluate whether the public equity market is cheap or expensive, not to evaluate the prospective dynamics between the valuation of financial assets and the volume of investment in the economic assets that they represent. Venture capital serves as a laboratory. The history of venture capital, the data generated by venture capital funds, is a laboratory for investigating the impact of financial speculation on investment and innovation. Over the 25 years from 1980, when VCs exited under poor IPO market conditions, when the market conditions were less than the index 2, their returns were also relatively poor. When they exited under bubble market conditions, when the conditions were greater than the index 3, the returns were spectacular. Now, Bob Harris, Tim Jenkinson, and Steve Kaplan have recently published the most comprehensive analysis ever of venture returns based on weighted dated cash flows. And they show in this time series that VC funds that matured in the 1998-2000 dot-com telecom bubble beat the NASDAQ index, beat any index you want, by 2 to 3 times. Since the bubble burst, VC returns have not even matched the index. And that is followed by the pattern of venture capital fundraising. This is profoundly pro-cyclical. As you look at the increase in capital committed by limited partners to venture capital funds from less than $5 billion in 1990 to $105 billion in the year 2000. The big state pension funds piled in, herd following, momentum investing in time to earn appallingly poor returns in the following 15 years. And since the bubble burst, following those returns, venture capital commitments by limited partners have returned to roughly the level adjusted for inflation of the pre-bubble mid-1990s. Now, a few economists, 2 of whom you're going to hear from on this panel, a few economists have crossed Keynes's bridge and have actually considered the conditions under which and the manner in which speculators and entrepreneurs interact with each other. This is the paper by Angelatis, Lorenzoni, and Pavan, the first 2 of MIT, the third of Northwestern, who talk about the game played, a game played between entrepreneurs and speculators. I would just point out, and I've highlighted it, the kind of obeisance to the mainstream neoclassical gods represented by their repeated use of the term as if it were a beauty contest, as if there were irrational exuberance, when in fact, of course, that's exactly what is going on. And they do themselves also call out the significance of this game when technological change is creating greater uncertainty about prospective returns. Again, they use the notion that the information is dispersed, as if it were already there, when of course the point is it doesn't exist. Only when the investments are made and realized will we find out whether or not those investments will be worthwhile. We'll hear more about, I think, what happens across Keynes's bridge from Steve Fazzari and Ramana Nanda. But let me just point out that Amazon exemplifies the productive role, productive at least for Jeff Bezos and for customers, if not, as Simon Head told us in detail, for the employees of Amazon. It took $2.3 billion of risk capital to get Amazon to positive cash flow from operations. And if the last funding 2 weeks before the all-time peak in the NASDAQ had not taken place, that's $670 million of convertible bonds, as Stone in his book about Bezos and Amazon wrote, Amazon would have gone bankrupt, and we would have seen a substantial deferral of the growth of e-commerce and the digital economy. So let me conclude by suggesting some pointers about where we are now. Now, is evidence. There's a lot of speculation around web startups that have demonstrated some traction with users in potentially very large markets, and investors are not requiring them to demonstrate profitability. On the contrary, as a marker of bubble speculative behavior, it's almost celebrated if they are spending more money than they're taking in because they're going big and going for broke. And whether or not they get broke and get there is why we live in a world of Keynesian ontological uncertainty. But there is some signs of the IPO market, some very misleading signs of the IPO market returning. This is the press release from last week by the National Venture Capital Association celebrating the apparent recovery of the IPO market. Over these 40 years since there's been an active IPO market in venture-backed companies, the mean number of venture-backed IPOs through 2005 was 30 with a standard deviation of 10. So more than 20 IPOs is an indication that we're back to normal, except over the last 4 quarters, if you take out the very special set of biotech startups that have gone public while losing money and with no drugs yet approved by the FDA, we would be back under 20. And in fact, of the 36 IPOs in the most recent quarter, 19 of them were for biotech companies of the sort that I have just mentioned. And in fact, what's going on is a special speculation demonstrating and responding to the radical loss of productivity in research and development investments by big pharmaceutical companies. The speculation is that the biotech companies, the biotech startups, will be acquired by big pharma before we have to find out whether or not the molecules that they're testing will actually get approved. It is a very limited activity. And in fact, the big market, the S&P market, and this is the long haul. This is 1881 to date. The S&P market valuation is nowhere near the bubble peaks of 1929 and 2000, even while long-term interest rates have returned to the lowest levels recorded, with the even lower than they were when the market was supported during World War II. So, with that as a kind of broad suggestion that bubbles can be productive, that when they are productive, they mobilize capital at very large scale for projects whose returns are uncertain, that many bubbles are not productive, and that right now, the innovation economy, despite the surge in speculative investment in these 2 narrow sectors of internet and biotech stocks, both of which appear over the last week to be entering major corrections, the innovation economy, for good or ill, is on its own. Thank you very much.
Thanks. Thanks very much, Bill. Next speaker is Steve Fazzari from St. Louis.
So I show my age by putting my reading glasses on. I used to be able to give talks without glasses. This session is a little removed from the things I've been working on for the last few years, but it's very closely tied to things I've been doing over the last several decades, and I appreciate the opportunity to talk about this work and for the invitation here on this really interesting topic. So the work that I've been part of actually since graduate school is to talk about finance and how financial markets matter for macroeconomic outcomes. And it may surprise some of you who are not familiar with the ins and outs of the economics literature on these topics that this has been a big debate for decades. There's still no unanimous view, but I've learned recently that unanimous and consensus are not quite the same thing. And things are a lot different now than they were in the 1980s. I would argue that there is a close consensus at this point that access to finance affects business decisions that feed into macroeconomic outcomes and growth, into innovation. The kinds of things that Bill was talking about in the previous session, or in the previous talk, are in fact quite relevant, and there's a lot of academic empirical work to support these kinds of effects. And I'm going to share some of the things I've been involved in here over these next few minutes. What I may say here is that finance is not just a sideshow, it's fundamental to the way that the economy operates. That's kind of the big picture question. The more focused question for this session is, how does speculative financial bubbles affect innovation? And the particular context that I want to work from, and that Bill introduced, is two recent bubbles of great significance. One is the technology bubble of the 1990s, and the second is the housing bubble, which timing differs in the work I've been doing with Barry Cinnamon. We would probably date this earlier than a lot of people, but it's well known to be something that really got to its most extreme peak in the middle 2000s. So I have two perspectives to share on these ideas. One is a microeconomic perspective, and it's largely a direct channel, where the notion that rising stock prices can affect the supply of finance for innovative activities, and that this supply matters for the amount of innovation taking place. And the conclusion of this direct channel is going to be that the technology bubble of the 1990s did have an important effect on research and development, and I'll share some evidence with you along those lines. The second channel is more indirect. It's a macroeconomic channel, and actually more related to my recent work on the housing bubble and the consumer debt process that was associated with it. But it's going to spill over to innovation the following way. Large and widespread bubbles do in fact induce significant stimulus to demand and to the aggregate economy. When the good times roll, we get high profits, optimistic expectations, and the expectation about the rewards from innovation are going to be strong. I think this ties nicely to the breakfast panel this morning on reflexivity, because it's the same kind of idea. And the conclusion here might be a bit controversial. The conclusion I'm going to draw is that even though the housing bubble was non-productive in the sense that Bill Janeway just talked about, in a direct sense, it did lead to substantial demand stimulus, and that likely had a spillover indirect effect on innovation. So that's the basic story. Let's take a look. You know what? These are very nice slides. They're for my talk tomorrow. So who's borrowing triggered the Great Recession? If you are curious, please come tomorrow afternoon. This would be a medium disaster, except for the following sense. I didn't really plan to use slides very much in this talk at all, so maybe we'll just go back to, yeah, that is in fact the title for tomorrow's talk. So maybe the people doing this, well, there we go. We're not looking at anything. We'll find the right slides, maybe they won't. Fortunately, it doesn't really matter. So let me talk now, back on topic here, get to the direct channel that I talked about, the link between finance and innovation. And I should say that the points here are based most directly on a 2009 paper that appeared in the Journal of Finance, co-authored with my longtime friend and colleague Bruce Peterson and our former graduate student James Brown. But it's also informed by a lot of other work I've been doing going back into the early 1980s on these topics. So the basic microeconomic foundation here is that there are financial constraints, that the ability to obtain finance for investment projects or R&D projects can constrain whether business in fact undertakes those projects. So here the point to make is that a good idea is necessary but not sufficient. You have to have a good productive idea to do something, but just because the entrepreneur or the firm has a good productive idea doesn't necessarily mean that project will be undertaken, because that idea has to be financed. Now, the source of finance for innovation, in particular R&D, in high technology companies in the US is almost exclusively new equity. If you look at our 2009 study and look at high tech firms, you'll see that less than 2% of their new sources of finance comes from debt, which is really a striking number. The equity can come from internal or external sources. You have internal cash flow, of course, as well as new share issues. Cash flow is the biggest source for all the firms in all the high-tech firms in our study. But for young firms, which we define as firms within 15 years of their initial public offering, external share issues are certainly not trivial. In fact, they're 32% of finance in our sample. So the question here is, does the supply of new equity, either in the form of the cash flow the firm is generating or the new share issues, affect research and development? Well, you might think the answer is obvious. Research and development has to be financed. If supply is limited, that's going to constrain the innovative activities. But in mainstream economics, this perfect capital markets view was dominant through the 1960s, 1970s, and really probably largely through the 1980s as well, although things were changing by that point. So the perfect capital markets notion would be that all that really matters is productivity. All that matters is having a good idea. If you have a good idea, something that the business decides is in its interest to undertake, it will happen, and the finance is basically a sideshow. Our research over many years is an attempt to test that hypothesis, and we and many others largely reject it. In this particular case, we're looking at the supply of new equity finance for R&D. Our regression results show that there's very robust effects of both cash flow and proceeds from new equity issues, but only for young firms. And I want to emphasize that only for young firms aspect, because this idea of heterogeneity has become a really important part of this literature testing these effects. And the problem is that there is a reverse causation problem. If you we're basically looking at the way that investment or R&D responds to cash flow or profits or the issue of new shares, you might say, well, sure, if you have a good idea and good projects, then you're going to have high profits and high cash flow. So the causation goes the other way. The problem we need to do is to tease that out, and there are lots of econometric techniques for doing that, instrumental variables, various kinds of controls. But the one that's been most powerful in our context, we've got the slow recession again. Good, come tomorrow. I'm seeing it, you're not, sorry. But the wrong slides are still up there, folks. Okay. So the heterogeneity is particularly important because this idea that somehow if you have good projects, your profits are going to be high and your research and development is going to be high would be true for small firms, large firms, young firms, old firms, firms that pay dividends, firms that don't pay dividends. What's helpful is that a young firm in particular, one that's less known by the capital markets, is more likely to face these finance constraints. So if we find that the effects are bigger in the young firms, that's really stronger evidence that these really are the supply of equity effects as opposed to some kind of reverse causation. So let me apply these results to the 1990s tech bubble and R&D spending. So there was a huge boom in research and development from 1994 to 2000. And this is the one place where my slides would show you a chart from the paper. And you can see this. It was closely associated with the tech bubble. Then after the bust of the bubble, R&D fell quite dramatically. So there's clearly an obvious correlation between the bubble and research and development. The question is there causation? Now, one fact here, again, that this would show up on the chart in the paper, is that the bubble was entirely concentrated in young firms. There was no boom and bust for mature firms, but we looked at the data, and sure enough, the mature firms also saw a massive rise in stock prices. So this suggests that there really is a financial root to this R&D bubble that was associated with the technology equity price bubble. Oh, thanks, okay. The estimated finance effects from the regression show that really the cash flow and equity can explain about 70% of this bubble, and it's all concentrated in the young firms. So it's really a quite significant link between the bubble, the financial flows to these firms, and ultimately their actual research and development. The conclusion being that the bubble did matter for innovative activity. So I'm going to jump, in the interest of time, to the second of my channels, which I guess is a little more, not as detailed, but I think interesting, this idea of indirect stimulus from bubbles. So again, if you have something like the housing bubble, I don't need to justify to this audience that had a huge stimulative effect on the economy before it happened. A big part of that of what happens then is rising profits and rising cash flows. Cash flows matter for research and development, so it seems likely that that's going to spill over to innovative activity. And the conclusion here is that the economy was, because it was stronger for 2 decades due to the housing bubble and the ability of homeowners to pull money out of their houses, use their homes as piggy banks, that this stimulus boosted innovation by raising cash flow, raising asset prices, stock prices, and ultimately raising the demand for R&D. So I'm not really disagreeing with Bill Janeway's typology, where he talks about this bubble as non-productivity enhancing. I don't think it was productivity enhancing in a direct sense, but the indirect macro stimulus could stimulate internal finance in particular that could have an importance for research and development. That's a bit brief, but I hope you get the main idea. Let me finish with last point on the social implications here, which is that I'm arguing that bubbles likely increase the incentives to innovation and the flow of funds for innovation. The effects are most obvious for the tech bubble, but I would argue there was an indirect effect even for the housing bubble. But this does not mean, and I want to emphasize this, that bubbles are somehow good. The stimulus happens on the way up, but what goes up must come down, and the effects are reversed to the crash. We all know that the recessions that followed these bubbles, especially the one following the bursting of the housing bubble, was hugely damaging and painful. You might say, well, the net effects are unclear. There's some stimulus on the upside, some reductions in the downside, but I'm not sure that's the right question. Because at the end, the reason that we have the reason that these effects work are because of structural problems in the economy. In the case of the direct microeconomic channel, the structural problem is the inability to obtain adequate finance for good, innovative ideas. In the case of the macro channel, the problem is insufficient demand. And it might be better to address those problems directly than hope we get innovation created by these bubble processes, which when they crash are exceptionally painful. So the slides in front of me are the right ones, but I'm out of time, and you hopefully got the idea without the slides. So thank you very much.
Thanks, Steve. Apparently the slides will be posted on the website. You did a manful task there without your slides, Steve. So, sorry about that. Next up is Ramana Nanda from Harvard.
Thanks very much for including me on this panel. The fact that I'm going third is actually very nice because Bill sort of set the stage for the productive versus less productive bubbles. Steve then talked sort of with a connection with the macroeconomy and sort of the role of finance in R&D at a macro level. And what I'm going to do for the most part is sort of talk about the micro foundations. This is work that I've done with my colleague Matt Rhodescroft. Talk about the micro foundations of why a bubble might be sort of productive from a technology standpoint, really digging into our research that we've done in the venture capital industry. So what I'd like to do is to motivate the idea that at the birth of industries, you see a very consistent pattern of a whole set of firms that get founded and then a shakeout that comes after that. These are sort of 4 pictures from different periods of time: automobiles, tires, televisions, and penicillin. This is data that Steve Klepper has put together. But this is a pattern that is very robust across a whole range of industries across time, and is certainly kind of familiar as we think about the internet, even if we think about the clean tech sort of semi-bubble that happened recently. This pattern sort of suggests that there is something systematic that's happening at the birth of industries. And what I will suggest is that it sort of suggests an underlying process of experimentation, where people are trying to figure out how the technology is going to be applied. They're going to try to figure out what's the appropriate business model, how is this going to be monetized. And the only way, kind of as Bill has talked about, and going back all the way to Keynes, the only way we really figure this out is by putting money into these companies, running these experiments, and learning through experience about how these things are going to work and how they're not. The next thing I will sort of contend, and again, Steve sort of set the stage for this really nicely, is that the capital markets are going to play a central role in financing this experimentation in the economy. And I'm going to give sort of examples from the venture capital industry, but I think the reason why sort of we begin to sort of preview some of the work, the results that I'm going to show, the reason why we care about sustained activity that kind of exists in bubble periods is that these might be times when the capital markets can really help with the experimentation that takes place early in the life of industries. Okay. venture capital has, again, as sort of Bill had pointed out, has really been associated with commercializing radical innovations, particularly in the US, across a spectrum of industries, although relatively narrowly defined. And one of the things about venture capital that's sort of important to realize is that it is associated with staged financing. So there's a little bit of money that's given, we figure out whether this technology works or not, and then if it does, we kind of give it a bit more money. Okay? And so part of the challenge in a world where we give it a little bit of money, we preserve real option value to shut down these projects, is that we're playing a game of coordinating across time. And if we believe that there's not going to be sufficient financing for this company in the next period, and we don't have the funds ourselves to take this through to cash flow positive, our beliefs about other people's beliefs about this company become very salient. And so part of the work that Matt Rosecroft and I have been doing is to help sort of demonstrate that there's two aspects to commercializing technologies. There's the fundamentals about this company, but then there's also our beliefs about whether this is a period where other people are going to be bullish about the sector, whether companies are going to get funded or not. And if it turns out that our beliefs about the future are not very strong, we may be less willing to fund the same kinds of companies despite the fact that they are the same inherent company. And I think the example that Bill gave about Amazon is a nice one, because it suggests that, you know, the very fact that we happen to be in a period of sort of sustained activity versus not can have very profound implications for whether the same company that has the same underlying fundamentals gets financed or not. And so what I'm going to argue is that one of the things that bubbles do, one of the productive elements of bubbles, is that they reduce the barriers to experimentation by investors, and this allows them to take on more risky, more novel, innovative technologies, and in doing so, that sort of helps with the commercialization of technologies later on in their life. Okay, so it's possible that some of you know this, but this is a slide that I am constantly sort of surprised by, so I like to sort of talk about it. This is the portfolio composition for a real venture capital firm for which we have data. It is one of the leading venture firms. It has been in existence for a long time, and it manages hundreds of millions of dollars in its portfolio. The partners are clearly not stupid people. Okay. But what I want to show you is the return distribution for this venture capitalist. So the dark blue bars essentially are the share of investments that end up in these various buckets. Okay, so across the bottom you have the most left-hand column is those that are terminated below cost. So this is less than 1 times the investment. The next is between 1 and 3x. The next is between 3 and 5x. The next is between 5 and 10x. And then the last is greater than 10x. Okay? So the light blue columns is basically the share of the gross returns to this VC's portfolio that come from investments that are terminated in those buckets. Okay? So what this essentially shows you is that 60% of this venture capitalist investments end up getting terminated below their cost of investment, and they make tiny amounts. They get liquidated at 10 cents on the dollar. And that's why the light blue column on the left-hand side accounts for under 4 or 5% of the overall gross returns that this VC makes. Okay? And then going to the right, you can see that the two rightmost columns account for essentially 75% of the gross returns. So 10% of companies account for 75% of the gross returns of this company, of this VC. So what's the point of showing this? The point of showing this is sort of highlighting in very real terms that it is impossible, even for these very sophisticated investors, to know, conditional on making an investment, which investment is going to be successful and which isn't. In fact, 60% of them are going to fail and get terminated below cost, and there's just going to be 5 or 10% of the investments that are going to make the entire return for this venture capitalist. Okay? In fact, for this same VC, we find that conditional on making an investment, the correlation between the internal score that the partners give this company at the time in which they invested and the overall outcome was about 0.1. Okay? So that's just another way of saying it's very hard for them to predict which company is going to work successfully or not. I think the other thing that's important to say is that there is this notion, the Bessemer Ventures very nicely puts on their website what they call the anti-portfolio. Okay, so these are companies that they had an opportunity to invest in, but chose to pass on because they thought they were not good investments at the time. Okay? And then they sort of talk about why they passed on it. So they passed on Apple, they passed on eBay, stamps, coins, comic books, you got to be kidding, right? Google, they were, at the time, it was a search engine run by college students in a space that was already dominated by search. It was not clear that this was going to be a great company. The quip was, how can I get out of your house without going close to your garage? Okay? And there are other companies that they've invested in that have similarly, chose that they had an opportunity to invest in that they chose not to. Okay? Fred Wilson from Union Square Ventures has similarly talked about passing on Airbnb, which some of you might know. He just talks about the fact that thinking about people renting out their mattresses just didn't seem like a business that could make a lot of money, yet this is now one of the largest, it has sort of, if you look at the sort of the chain of rooms that they have available, it's sort of larger than any of the mainstream hotels that are in existence today. Okay? So I think that this is perhaps for this audience is not going to be surprising, but it's sort of important to stress that at the time of the investment, it's just really hard to know ex ante whether an investment is going to be a great one or not. And this is why sort of the opportunity to experiment, the opportunity to take a lot of bets and then figure out what works ex post is really the way in which our economy makes progress, is really kind of, I think, one of the sort of the central aspects of capitalism. It allows a diversity of opinions and a diversity of business models to flourish. And my contention is that in sort of early in the life of industries, sort of sustained activity really allows for that experimentation. So in my last few minutes, I want to talk about a paper that Matt Rosecroft and I have published in the Journal of Financial Economics, which really kind of tries to take seriously this notion of worst projects versus experimentation. Okay? We have this notion that companies funded in hot markets tend to be worse, and the reason we have that notion is that they're associated with very high failure rates. Okay? And our contention is that in fact, looking just at failure rates is going to be misleading in terms of thinking about whether it's worse projects or more risky projects that are funded in these times, because you need to look at the right-hand tail as well to really understand whether it's risk versus just a sort of a fundamentally worse distribution of projects. And part of what we find is that companies that are funded by venture capitalists in hot times are systematically associated with ending up in both tails of the distribution rather than just the left-hand tail. So we do find that companies are more likely to fail, but conditional on success, they sort of have much, much bigger successes. And then we try to show that this is a within venture firm effect so that it's not being driven by the distribution of investors who come in hot versus cold markets. We try to show that this holds, controlling for the time when you exit the market, and then we try to show that this is sort of a causal effect. That's obviously the hardest thing to do. Okay? So the last thing I'm going to sort of talk, to wrap this up, the reason I think that this is really important is that going back to Steve's point that he mentioned, young companies don't have internal cash flows. They depend critically on external sources of finance. And so we believe that sort of the buffeting of the capital markets, bull times versus bear times, and the beliefs about investors investing in these companies will have dramatic effects on the distribution of the kind of innovation that gets funded in the economy for small companies, but for large companies that essentially don't face financing risk, that's going to be less of an issue. So we sort of have a micro model that's very supportive of what Steve seems to find, which is that it is really the young companies that are much more volatile with respect to the ebbs and flows of the capital markets relative to old firms or sort of older firms that have underlying cash flows. Okay, so to sort of wrap up, I think the main point that I want to put forward to you is that I think extreme failure and extreme success often go hand in hand. because it's hard to know up front what's going to work and what's not. And I think the capital markets can play a fundamental role in financing the experimentation that takes place, particularly early in the life of industries. And it's in that sense that I think there is sort of a positive role for bubbles of activity in the capital markets. Thanks.
Our final speaker in this panel is Peter Jungen.
Thank you. I'm talking only briefly about a bubble. If we thought that there were bubbles in the last years or so, if you go back in 1637, we found out that there was a real bubble and on tulips. And the highest price ever paid for such a flower was 10,000 guilders at the time. This was the price of the most expensive homes in Amsterdam. So I think then we understand really what a bubble is. Life has been boring. In his new book, Eric Brynjolfsson points out that for the 30,000 odd years we know, nothing much happened. And it was only in the 10,000 before Christ, and then the 1,000 before Christ until today, when we found out, and he found out that growth was about 0.1%. And it is only per year that since recently, this is at 1.5%. Why is it, did this happen? 200 years ago, 85% of the world population were living in extreme poverty. And the GDP per capita in 1780 was exactly the same like in 10,000 before Christ. I'm not going to bother with these numbers, but I would show that innovation obviously is at the key of everything, and innovation is at the bottom of the modern. Without that, we would never have become. It's the only justification for a capitalist system, creating the dynamism which is important to support the people who live today and live much better and longer and healthier than ever before. Maybe the most important innovation, or invention rather, which we had, is printing the book. And when the books were, the machine was invented by Gutenberg about shortly before 1450. Until that time, dissemination of knowledge was only happened through copying books by hand. So an average monk was able to copy 28 books in his lifetime. Those were the only people who were able to do that. So after the printing machine was invented, they had more books were published in the following 50 years than had been copied in the time since the foundation of Constantinople in 250 after Christ, just to give an idea on what it was maybe the most important in innovation and invention and then in innovation in the history. The innovation is the foundation of economic dynamism and prosperity, and the process involves, of course, science, entrepreneur, and the state, as we know, but we have to make the difference between the invention and the innovation. The one is the turning money into knowledge. This is the R&D. A lot of his government spending, but turning the knowledge into money back, that's the innovation part of it. And that explains all modern growth. In particular, as we find out with Schumpeter, entrepreneurs are pushing innovation, using the phrase of creative destruction, that is the old is to be replaced by new, and that is through the entrepreneurs. Otherwise, there would be no innovation. On the instability of the economic development, on the bubble, there's an interesting notion from 1928, Schumpeter, he wrote a piece on the instability of capitalism and deciding that capitalism's defining idea of constant change and innovation makes the whole idea of a capitalist equilibrium misleading. Hayek added in 1964, to recognize the high degree of our ignorance is very important. And therefore, I think we should rather maybe using instead the word of capitalism on the innovation economy, as Bill has done this in a book. So what is this about? About relentless search, discovery, about customer advantage, about success, and of course, about failure. Most of the firms who are founded don't make it for the first 5 years. At least this is according to all the statistics, and Phelps in his recent book, Mass Flourishing, points out to the fact of the bottom-up development, which has to involve so many entrepreneurs who never will be known because most of them have to fail, and most of them, unfortunately, will fail. That is the way of the experimentation way, and therefore it is so important to encourage people to start the business. To start a business is easier than to run and to grow it. It's about the idea creation, about the business model, about the revenue model, about the business plan, about the equity funding, about coaching, and it's about execution in particular. Execution is the main key. There's no good idea which has any value unless there is the execution part. And you can have a great idea, and with a lousy execution, it won't work. And maybe a second-class idea with a very good execution by an entrepreneur may be a success, and maybe even a successful company. So therefore, it is to see with some sorrow that the numbers of startups, in particular in Europe, are going down constantly. We are on the lowest number for the last 15 years. So it is so important to create an entrepreneurship-friendly environment, is not to do a favor to entrepreneurs, but rather to use the entrepreneur in solving problems which otherwise in a society cannot be resolved. For instance, for Europe, we probably need about 6 or 7 million new entrepreneurs to solve the problems. And this is way off from the present activity. So as innovation is driven by entrepreneurs and in particular by startups, it is so important that we increase not only the number of startups, but that more of the startups have a chance to grow fast, what they call the gazelles, to grow fast and into larger firms. But that is only true of those who survive, of maybe 10, 15%, not more of them could classify for that. Therefore, the entrepreneurial policy is so important, and as you could see from the Doing Business Index of the World Bank, it's interesting to see that there is a very positive correlation between good rankings in Doing Business Index of the World Bank and economic growth. And in Europe, you have a very negative correlation, and that is, as you can see, for instance, countries like Greece. In 2009, Greece ranked 109, directly behind Bangladesh. Today, it's a bit better, around 90, but still after Mongolia. So I'm not blaming Mongolia, I'm not blaming any one of them, but I just want to point out how important it is to have these startups and have these firms and allow with the framework condition for them to be started not only, but to grow very fast. Yes, thank you. The good thing about the US, obviously, is that the US have about 5% of the world population, 23% of world GDP, or 22, 40% of R&D spending, 75% of the venture capital in the world, and more than 90% of angel investing. And therefore, adding on what has been said to the venture capital, in 2013, the numbers are better than they were before. It's improving. It's about 4,500 firms which were funded in 2013. But on the other hand, and it's roughly 30 billion now again in the US, which is by far the biggest investor and country investing in startups. But if you really want to have more entrepreneurs, you need more angels. And if I may add the recent numbers for last year from the Center for Venture Research, then we have 20 billion invested in startups. by angels, in 60,000 firms with the 270,000 angels, and the majority of the money is in the seed phase. So what we really see is what has been said before on the mass flourishing is the bottom up, and it's so important that we increase the number. And to conclude this, the question is really, are we running out of innovation? I'm sure definitely no. There is no reason to believe that we would run out of this. And Brian Johnson, in his newest book, said one of the recommendations is startup, support the startups. And if this is the case, so we support the entrepreneur. Being an entrepreneur or becoming an entrepreneur is not very profitable. The median entrepreneur certainly is in red territory. He doesn't make any money. The average may make money, but most of them fail. A small number may be doing so-so. A few could become rich, and the very, very few become very rich. If we do not allow this, we would not have all the others in fostering innovation. So if we want to support all these people who are not starting their own business, we need to support with the framework condition those who are able to do this. And let me conclude this. Why should we see an end of this development? We have 500 million people working in the OECD countries at $135 a day. We have 1.1 billion people working in the world outside the OECD countries for about $12 or $15 a day. We have another 1.3 million working in agriculture. So since the end of the war, the people who are involved in the world economy as working force were 500 million then, increased almost to 2 billion. And there's every likelihood that this will increase for another 2 billion in the next 30 years. So there is no reason to believe that innovation would die unless we do not allow for the entrepreneurs to bring their contribution to that. Thank you.
We're going to take some questions from the floor. I'll just start with a couple of quick questions for the panel, and then, so if you've got questions, please look around for the mics. First one to you, Bill. This distinction between productive and non-productive bubbles that you make, can we identify these bubbles at the time where they're productive and non-productive? And if we identify a productive one, should we encourage it? You know, get interest rates, keep QE going forever to encourage productive bubbles?
Well, I think it's possible to identify the locus of speculation. And there is ample evidence, for example, that when loan to value ratios go up, when conditions on loans go down, as they are again in the LBO market, when people are lending, when banks are lending money on a basis that suggests they don't really care whether they get repaid, which happens when they offer the borrower the option, at the borrower's option, to not pay cash interest, but to pay in kind. This is when our great lost leader, Hyminsky, would say, we have entered the Ponzi financing regime in the banks. And when that happens, it almost doesn't matter what's being funded. It's got to be stopped. And that's where an active central bank concerned with financial stability as well as with inflation targeting has a very positive role to play. When it is, however, the liquid capital markets, and particularly the stock market, it appears that the cost of the bubble bursting is relatively modest. And it's very important to distinguish, in this case, historically, between 1929 and 1931. 1929 was a stock market crash which did not devastate the American economy or the world economy. It was the 1931 banking crisis globally that was directly responsible for the Great Depression. So I think it is possible to distinguish and discriminate with respect to bubbles. I do want to add that I agree entirely with Steve that even the unproductive bubbles, even the bubbles that have negative consequences on the upswing, will generate full increase aggregate demand and create an environment in which creative destruction will be more creative and less destructive.
Right. Does anybody else have a thought on that? I mean, let's go back to the tech bubble, for example. I mean, if you make the argument it was a productive bubble, maybe Greenspan did right to let it keep it going till 2000. I was writing things, 1998 saying time to raise interest rates, but was Greenspan right? I mean, the counter argument is surely with the bubble burst, the Fed then has to step in and launch another bubble, which is the housing bubble. So, that's the counter argument, but am I wrong? Maybe was Greenspan right?
I could throw a little bit of some idea there. Can't answer that question directly. Was Greenspan right? But I think one issue is the political economy problem in this case. People are making an incredible amount of money in this environment, and it's probably very difficult to step in and take the punch bowl away in that kind of context. It's more of a positive rather than a normative response to this.
I do think that, in fact, Greenspan made his irrational exuberance talk in 1996,
right.
Before things really got rolling. The mobilization of capital, as Steve's slides you will see show, when you look at them, was phenomenal. And it did fund an enormous amount of trial and error experimentation about what to do with this new environment, as it funded also the laying out of the cables, the building of the infrastructure for the internet.
Right.
So, John Doerr used to talk about in 2000, before it burst, that the $6 trillion of increased wealth in stock market values was the greatest legal creation of wealth in history. Well, the $6 trillion that it took 3 years to create vanished in a year.
Right.
And the recession of 2001 was a very modest recession. And because Greenspan had to reduce rates at that point, doesn't mean he couldn't have, and the regulators couldn't have cracked down on the housing bubble 3 years later.
Right.
So the answer is yes, Greenspan was right.
Okay, Peter, you have a thought on that?
Yeah, to add one observation, the highest number we had in spending on VC ever in history in this country, in the US, was in 2000 with about 100 billion. Before that, we're talking about, if you go back in the 80s, it was less than 1 billion. And then it grew over 20 years. And then in the run-up for 2000, it really jumped. And then it went to 2000, and then it fell down again. And it was below 20, and it is now recuperating to 30 last year, not counting angel investing. So basically, there's still a lot of money involved, but compared to 2000, of course, it's a lot less. So that was certainly that a lot of people believed in a kind of a development which would go on and on and on. And although many people said the money is wasted, the 100 billion, no, and the money is lost. No, it's not lost. It's someone else has the money, maybe not the people who invested this. So the money hasn't been lost. And it certainly is one of the bases for what we're seeing now. In Europe, early in 2001 and 2, many people thought, oh, this idea on internet, on all this is a bubble, this is over. And that was the time when it really started. And a similar thing is we're seeing now. When people say, oh, now it's going very fast. I think for the digitalization of industry, for instance, we're just seeing the beginning, what they talk about Industry 4.0. In particular, if you could see that for the German machinery industry, there is a complete new wave of innovation part going on now at the present time while we were sitting here. So one of the reasons of the funding of that time is now trickling down into the digitalization of old industries. And a country like Germany may have the big advantage that most of the industries in this country or in Western Europe are about 100 years old technologies, machinery, chemical, and what. But the digitalization brings them in a complete new area. The only disadvantage is they are not part of the breakthrough technology themselves, but they're using it finally. And so finally you could say the bubble from that time is now trickling down in the digitalization of the machine industry in Germany.
Okay, I'm almost convinced, Ramana.
So I guess just sort of building on what Peter said, I think one of the things that's interesting about the financing of these technologies, particularly as they become general purpose technologies, is that they have feedback effects into experimentation or the cost of experimentation in completely other domains. So I've written a case on a company called TerraPower, which is a nuclear startup. that was seed financed by Bill Gates. And one of the things that they talk about is that they're using a traveling wave reactor. They're using a technology that back in the 60s and 70s was too expensive to try to see if it worked or didn't work. Because the only way you could figure out if it worked was that you had to invest $6 billion, build a reactor, and then switch on switch it on and figure out it didn't work. But now the supercomputing technology has become so good that in fact for a mere few $100 million, you can actually very accurately model the inside of a nuclear reactor. It turned out that they did some initial modeling, figured out that their first idea didn't quite work, but they could pivot in sort of the parlance of a lean startup model to a new technology, and that was allowed because of all the great supercomputing power that has developed to date. And I think these things can continue. You could think about it in other domains, infrastructure, telecommunications infrastructure, or various, the Amazon's cloud computing platforms. All of these have basically made the cost of experimentation a lot lower, which means that people can try out a whole bunch of things for a lot less money before they figure out if they work.
Can they experiment without a bubble? I mean, the market's there all the time.
The market is there, but the finance, as Steve said, it's the financial constraint
Right.
on the new innovative firm.
Right.
And also the mobilization of capital at the scale necessary to build the infrastructure that creates the environment that makes it cheap for others. You know, and what Peter said is absolutely right, and history does rhyme. So, the 1920s, the greatest growth industry in America, funded by the stock market boom of the 1920s, was electric powered generation and distribution. In the 1930s, under depression conditions, manufacturing productivity in the US rose at a more rapid rate than at any other time. Why? Because it became possible for the laggard small businesses to plug into the grid and electrify their production and radically improve their productivity.
Okay. Thanks. We're going to take some questions from the audience. It's a bit difficult to see from up here. Chap there. Yep. Ask a question, please. No speeches.
I'll ask a question. I've been trying to ask a question for about 4 sessions, so finally, this is probably the most important one. I think you're putting too much emphasis on small firms. Small firms have an impact when they grow big. And the problem is, when the small firms you're talking about grow big, they stop investing in innovation. And what I would add to your title there is manipulation. I don't need to go into it because I'm talking in the next session about stock buybacks. But if you look at companies like Cisco, Microsoft, et cetera, the problem is the stock price, getting stock price up is so much in their DNA from the way they get started up that they never stop thinking about stock price, and it becomes an American
What's the question,
disease.
sir?
That is my question. How are you dealing with this question of what happens when small firms grow big? Thank you.
Thank you. It looks like everybody wants to have a quick. Keep it quick, please.
Schumpeter didn't just have a Mark I model, he had a Mark II model that innovation would become bureaucratized and routine. In fact, what we're seeing now, particularly in the absence of a hot, broad-based IPO market, is a kind of hybrid model of small firms being innovative and getting acquired early. And the challenge is for the big firms to be able to absorb the innovation from the outside. This is a work that we need a lot of academic work on this, but we need a lot of cultural work on the big companies not to kill innovation when they acquire it.
Anybody else on why big companies don't innovate?
Just a quick comment. There's sort of recent academic work. Shai Bernstein at Stanford has been doing some work to understand what happens as companies go public. He seems to find that they're systematically less likely to engage in innovation, but they make up for that by acquiring that innovation. And in some sense, that's not a bad thing, because if you think about the exit options that Bill talked about, or that I have in my model, if you have sustained acquisition at good prices from incumbents, that actually creates incentives to finance and fund companies from the perspective of initial seed round financiers.
Yeah, I think to add on this, there are two observations. Some people criticize larger firms for buying back the shares and not investing in innovation. I think this is the best thing that this management can do, because if they run out of ideas and think that there's no better company around than ours, why shouldn't they put the money into invest in the company? But the most important fact is that they release funds going back to investors, and these investors will be enabled to invest in new firms or startups or in VC funds or whatever. So I think this is a very good thing. The second thing is buying firms. Of course, people always get this wrong. They think the IPO is the most important piece in the food chain. This is, of course, wrong. The larger portion is the trade sales, and that is that small firms or medium-sized firms are acquired by larger firms. Most of that is not reported in any newspapers, for the simple thing is not a public event. And therefore, so many of these companies invest in this, and because they may think there are better entrepreneurs outside there than they have them in their own firm. So this is another way to make it up, and maybe instead of buying back the shares, they do this. But unless they don't have the good idea to invest the money in, then buying back their own shares and releasing the funds for other purpose is a very good thing.
Right. Gentleman at the front here.
Brian Cahan, MIT Center for Digital Business. Recently, a disturbing data has come out from John Halterwanger and his colleagues on the secular decline of business dynamism in the U.S. And how does the panel reconcile this with the qualified but moderately optimistic view of startups, except in Europe?
Yep, Steve.
So I'll take the macroeconomic perspective on this. We've got a really pretty lousy growth right now, very stagnant recovery from the Great Recession. And I think this, as I was saying in my presentation, spills over. And I would just make a comment too, thinking about John's original question on the 1990s, was Greenspan right, these kinds of things. One of the reasons the 2001 recession was not so bad was, in fact, because we started up the housing bubble, as Bill mentioned. And, it really cushioned that fall. There was a massive decline in business investment during that period of time, and it would have had a much bigger effect on the economy without the rising construction and consumption booms starting to pick up the slack at that point. So one clear problem we have about business dynamism now is the weak macroeconomic condition.
Well, I just say we're going to hear, I think, from Larry Summers, who has revived those magically depressing words, secular stagnation. And I wouldn't dream of trying to front-run Larry Summers, but I think we should all stay tuned for the closing talk.
Yep.
So I think it's important to note that John Halterwanger's research is using census data. Okay, so that's the entire economy. And as we were talking about before, there's sort of, there's 26 million firms in the US, 20 of them have 0 employees. There's 6 million with at least 1 employee. And there's about 500 to 600 firms that are born every year. A lot of what we've talked about is sort of a tiny sector of the economy, which is sort of the venture-backed sector. In the economy, the vast majority of firms are, retail, wholesale, trade, services, and construction. And those are going to be much more dependent on what's going on in the overall sort of macroeconomy. I think one thing I would qualify Peter's point, he mentioned there's 4,000 VC-backed firms every year. I think those are 4,000 investments that venture firms make. But if you think about the very first investment they make, there's actually only 1,000 of those out of the 500,000 that are born every year. So it's really tiny proportions.
Okay, gentleman at the front here has had his hand up.
Dr. Fazzari, you demonstrated how research and development expenditure is dependent on investment markets, and then sort of alluded to the idea that in average or down investment markets, that there are many ideas that are potentially innovative that are not financed. So what policy recommendations would you or other panelists make to ensure that the Amazons of the world are financed?
It's a good question. It's a difficult question. Microphone there. Hello.
Yeah,
Thank you. So I would actually point to Mariana Mazzucato's presentation yesterday, which I found quite engaging and interesting, about the partnership, public-private partnership, which is broadly related to this issue. There have been discussions about government funds specifically to fund private investment, and my co-authors and I, over the years working on these topics, have had mixed views on that to some extent. I'm coming around to the idea that actually, in some sense, the funding for these things should not be a scarce resource in our economy, and we could have more direct government activity, not just in funding projects straight up, but also in providing finance for private activity.
Bill, keep it quick.
This is a really important issue, and the problem here is, in particular, is when government is directly engaged in the experimentation phase of early stage venture-style financing, most of these ventures are going to fail. So this is why the market failure, Mariana's been very good about this, the market failure thesis that because under competitive conditions, for-profit companies will not invest enough in R&D. Ken Arrow, Dick Nelson, 60 years ago made that case. Because they will not invest, and the government should step in and do it. But then the government becomes subject to the same criteria of efficiency in the allocation of its resources, of taxpayers' resources, which cannot be validated. It can only be disproven. It will not be efficient. That's why mission-driven investments, and mission-driven procurement, where government agencies can be early customers of technology that is not yet ready for commercial prime time, as they were for semiconductors and microprocessors and computers, can play some role. But this is why I keep saying bubbles are not only banal, but they actually are necessary in that they can fund the experimentation. The speculators do lose money sooner or later, most of the time, but the trial and error experimentation takes place. Trying to get government to step in for that is almost certainly an error.
Peter, keep it brief. We're trying to get another question in.
Briefly, Amar Bidé has written in his book, A Venturesome Society. It's not talking only about the venturesome entrepreneurs, but also the venturesome, the customers. And that translated means basically one of the biggest support government could do for instance, for startups and increase their livelihood is being a customer for startups. And in a phase where maybe that it's still some experimentation, which is much better than trying to micromanage the startup and to get involved himself as the entrepreneur.
Okay, thanks. One more question, I think. There's a chap there. Yep.
Thank you.
Question, Roman, not a speech.
I actually have a question for the panel, but since in the interest of time for Bill. First of all, I appreciate the use now of speculative bubble, but the actual question I have is that the word bubble connotes I'm trying to bridge this panel with the theoretical panel, connotes the speculative psychological impulse, some kind of an exogenous psychological impulse that leads to the bubble in the stock market. That's not obviously what you are talking about. So what's the role of psychology in all this for you beyond the psychology in an animal spirit speculation that the general purpose technology is going to work out?
Thank you. Yep.
Well, very quickly, there's a huge literature, which I think is admirable, on how in a market environment, the implicit is, how long can you afford to be wrong before they take your money away and you're no longer in the market? So it doesn't have to be a psychological propensity for excessive risk-taking. It's simply a matter of fact that in the ontologically uncertain world that market participants live in, you cannot afford not to follow the crowd unless you're Warren Buffett and nobody can take your money away.
So just on that, Bill, you said bubbles are necessary, but to keep these bubbles going, do we need some irrationality then? I mean, do we need massive, or you're saying it's just
I'm saying that when the price becomes decoupled from fundamentals because no one knows what the fundamentals are, of course the bubble is going to burst sooner or later. Right. Along the way, chasing the bubble is, if you pardon the expression, rational for professional investors who are managing other people's money, and they will underperform if they don't chase the bubble, and the money will be taken away from them.
The last comment.
I think the most important difference is how the people who invest, how are they funded? Either by loan or a bank loan or equity. And that is why the trickle effect of the sort of the bubble bursting in the 10 years ago, 12 years ago in the internet and the .com didn't have any very negative effects other than you would have that in the housing bubble where money is taken away from the banks, and then you have this trickle-down effects go from bank to bank to bank to bank. And I think this is the key difference, and otherwise you maybe even just let that bubble run.
Okay.
For Greenspan, it is a point in the terms of interest rate is in the terms of the loan, but it's not on the equity.
Paul Davidson would say that what you should all read is the paragraph in the general theory by Keynes on how difficult it is to be a long-term investor.
Okay, that sounds like a wrap-up comment. Thanks very much, everybody. And thanks to the panel.